The power of compounding is one of the most talked about ideas in finance, yet it remains one of the most misunderstood. People often think of compounding as a mathematical trick, a formula that magically turns small sums into large fortunes. Financial legends understand it very differently. For them, compounding is not a number, it is a discipline. It is the result of behavior repeated correctly over long periods protected from interruption. When studied through the lives of the greatest investors, compounding reveals itself less as a strategy and more as a way of living with time. Warren Buffett famously described compounding as the reason his wealth looks extraordinary. The uncomfortable truth, as he often points out, is that most of his net worth was built after the age of 50. This is not because he suddenly became smarter, but because time was finally allowed to do uninterrupted work. The lesson here is not simply start early, but avoid interruption. Compounding collapses when capital is lost, when discipline breaks, or when impatience forces unnecessary action. Financial legends obsess far more over protecting the compounding process than accelerating it. Another lesson from financial legends is that compounding thrives on stability, not excitement. Benjamin Graham taught that avoiding large losses matters more than chasing large gains. Charlie Munger reinforced this by emphasizing the importance of staying rational during periods of boredom and fear. Compounding does not require brilliance every year. It requires the absence of catastrophic error. This is why so many legendary investors appear conservative. They are not minimizing upside. They are maximizing the probability that compounding is allowed to continue uninterrupted for decades. Compounding also extends beyond money. Financial legends understand that habits compound, just like capital. Reading daily, thinking clearly, managing emotions, and making fewer but better decisions all accumulate advantage over time. Ray Dalio often speaks about compounding principles, not just returns. Each improvement in decision-making quality feeds into the next. Over years, this creates a widening gap between those who rely on bursts of effort and those who rely on steady systems. The legends compound judgment before they compound wealth. Another critical lesson is the role of patience with uneven progress. Compounding is lumpy. It feels slow for long stretches and then suddenly visible. Most people quit during the flat periods because they mistake silence for failure. Financial legends expect these plateaus. They design their lives and portfolios to survive them emotionally and financially. This expectation allows them to stay invested, stay disciplined, and stay curious, while others churn strategies or abandon the process entirely. There is also a deep connection between compounding and reputation. Buffett, Munger, and other long-term figures emphasize trust as a compounding asset. Trust with partners, investors, and counterparties reduces friction, expands opportunity, and lowers risk. Reputation compounds when actions are consistent and predictable over time. Once damaged, it resets the clock. Financial legends protect reputation with the same care they protect capital because they understand that trust accelerates opportunity, just as interest accelerates money. Perhaps the most overlooked lesson is that compounding requires simplicity. Complexity increases the chance of error and interruption. Legends simplify portfolio strategies and lives so that the process can be repeated under stress. When decisions are simple, they are easier to execute consistently. When execution is consistent, compounding remains intact. This is why so many legendary fortunes are built on surprisingly few ideas held for very long periods. Part 1 reveals that compounding is not passive growth. It is active protection. It is the discipline to avoid the behaviors that reset progress: panic, overconfidence, leverage, and impatience. Financial legends did not beat the market year after year through genius. They allowed time to beat the market for them by staying out of its own way. And it is exactly here, when compounding is understood as a fragile process rather than a guaranteed formula, that its deeper power begins to emerge. Because the greatest threat to compounding is not market volatility, but human behavior. And this is where the second half of the lesson truly begins. Because understanding compounding intellectually is easy, but living in a way that allows it to work is rare. The second half of the lesson focuses on why compounding fails for most people, even when the math is known, and how financial legends structure their behavior to prevent that failure over long periods of success. Stress and temptation. One of the biggest enemies of compounding is overreaction. Financial legends learned early that reacting too strongly to short-term outcomes destroys long-term advantage. After a bad year, many investors abandon strategies. After a good year, they increase risk. Both behaviors interrupt compounding. Legends do the opposite. They reduce exposure after success and review process after failure. This counter-cyclical behavior protects the base upon which compounding depends. The lesson is clear: compounding survives emotional neutrality, not emotional intensity. Another critical insight is that compounding requires identity separation. When people tie their self-worth to performance, they sabotage the process. Losses feel personal. Wins feel validating. This emotional roller coaster leads to inconsistent behavior. Financial legends separate who they are from what their portfolios do. They judge decisions, not outcomes. This separation allows them to stay invested through drawdowns and to avoid arrogance during booms. Compounding requires continuity, and continuity requires emotional insulation. Compounding also fails when people scale too fast. Early success often tempts individuals to increase leverage complexity or lifestyle commitments. This raises the break-even point of life itself. Buffett famously avoided this trap by keeping his personal life simple. Low fixed costs gave him freedom to think long-term. Many financial legends understand that lifestyle inflation is a hidden form of leverage. When life becomes expensive, patience disappears. Without patience, compounding collapses. Another lesson from financial legends is the importance of long memory. They remember past cycles vividly. They remember how good times ended and how bad times passed. This memory tempers behavior. It prevents the illusion that this time is different from becoming dominant. Compounding requires staying invested across cycles, which in turn requires remembering that cycles are normal. Those without memory chase performance and abandon process. Those with memory stay aligned while others reset. There is also a powerful lesson about when to stop pressing. Compounding does not require maximum effort at all times. It requires knowing when additional risk adds little value. Legends often slow down after achieving financial independence. They stop chasing marginal gains and focus on preservation. This does not reduce long-term results, it protects them. The goal of compounding is not infinite growth, but durable growth. Knowing when enough has been reached allows compounding to continue quietly without being endangered by unnecessary ambition. Finally, financial legends show that compounding applies to character as much as capital. Integrity, patience, curiosity, and humility all compound. Small ethical compromises, like small financial losses, interrupt long-term trust and opportunity. Over decades, people who are consistent, fair, and reliable attract better partnerships, better deals, and better information. These advantages cannot be calculated on a spreadsheet, but they compound relentlessly in the real world. When the full lesson is assembled, compounding emerges not as a trick, but as a fragile privilege earned through restraint. It rewards those who are willing to be boring, patient, and emotionally disciplined long enough for time to work on their behalf. Financial legends did not discover compounding. They respected it, and this is where the story ultimately lands. The power of compounding is not about getting rich quickly. It is about building a life and a process that does not interrupt progress. Those who learn this early may never look extraordinary in the short term, but over long horizons they become impossible to ignore, because time magnifies whatever behavior you repeat, and financial legends chose behaviors that time could reward rather than punish.